We've all heard the term IPO, right? Some hot new tech company or a brand new love suddenly goes public, and the headlines just explode. But what does that really mean? Well, an initial public offering is one of the biggest moments in a company's life. And today, we're going to break down exactly how it all works. Behind every single one of those headlines is this incredibly complex, high-stakes journey. It's the process of transforming a private company, owned by just a few people, into a public enterprise, owned by thousands, maybe even millions of us. So how do they actually pull it off? You should think of it like a rocket launch. Seriously, it's this massive, incredibly high-stakes undertaking to propel a company into a whole new orbit. So let's get into the mechanics of how they make that great leap. At its core, an IPO is, well, it's actually pretty simple when you boil it down. It is the very first time a private company offers up shares of its ownership to the general public. And after that initial sale, those shares can be bought and sold freely on an exchange like the New York Stock Exchange or the NASDAQ. That's it. That's the moment a company officially goes from private to public. Okay, so why go through all this trouble? Becoming a public company means intense scrutiny, a mountain of paperwork. You've got to have some pretty powerful reasons, right? Let's dive into the fundamental why behind going public. The number one reason? Money. A successful IPO gives a company access to a huge pool of public capital. And this isn't a loan they have to pay back. It's pure cash they can use to fund massive expansion, develop new products, or break into new markets. It really is rocket fuel for growth. But it's a major trade-off. On the one hand, early investors get what's called liquidity, which is just a fancy way of saying they can finally cash out their shares easily. The company gets a ton of prestige and a clear idea of what the public thinks it's worth. But on the other hand, the process is incredibly expensive, it opens the company up to intense public scrutiny, and it carries the very real risk that after all that work, investors are just not interested. So, for a company that decides the pros outweigh the cons, what does that journey actually look like? Well, it's a highly structured 5-step process to get ready for liftoff. All right, here's the roadmap. It all starts with choosing an underwriter. Then you have to register with regulators, promote the stock to investors, sign the final agreement, and then, finally, the big day itself, the IPO. We're going to walk through each one. First up, and this is a big one, a company just can't do this alone. It needs a guide, a partner for this super complex mission. And that partner is the underwriter. The underwriter is almost always a major investment bank, and they act as the crucial middleman between the company and all of us, the investing public. These are the experts who help figure out the share price, navigate that crazy regulatory maze, and ultimately sell the company's story to investors. And choosing the right one, absolutely critical. Companies look at the bank's reputation, their track record with past IPOs, and of course the costs, which, by the way, typically run around 7% of all the capital raised. A top-tier underwriter can really make or break the success of the entire launch. Now, there are two main types of deals an underwriter can offer. The first is a firm commitment, where the bank literally buys all the shares from the company, taking on all the financial risk themselves. The second is a best effort agreement, where the bank just promises to sell as many shares as it can, leaving all the risk with the company if demand is low. Okay, next up, you need clearance from Mission Control. For a company here in the United States, that means the Securities and Exchange Commission, or the SEC. This whole step is about transparency and making sure investors get the real facts. And during this phase, the company enters a legally required quiet period. This means executives are strictly forbidden from hyping up the stock or saying anything outside of their official documents. The goal is to level the playing field, making sure every single potential investor gets the exact same verified information. All right, once the regulators give the green light, it's go time. Now the company and its underwriter have to go out and convince big investors that this is an opportunity they absolutely cannot miss. And they do this through what's called a roadshow. The company's top executives are literally flying around the country, pitching their story to large institutional investors. We're talking pension funds, mutual funds, the big players. They're trying to build up a ton of demand for the stock before it even hits the market. So while that roadshow is happening, the underwriter is busy with a process called book building. They're essentially polling these big investors, asking them, hey, how many shares would you buy at various prices? This helps them gauge demand and zero in on that perfect initial price for the stock. This all leads up to the final price meeting, which happens right before the launch. And let me tell you, it is a delicate balancing act. The price has to be low enough to attract buyers and make sure that first day is a success, but not so low that the company leaves millions of dollars on the table. And then it's launch day, but the work is far from over. Those first few weeks are absolutely critical, and underwriters have a few tools up their sleeve to ensure a stable orbit, not a fiery reentry. One of the most important tools is the green shoe option. This gives the underwriter the right to sell up to 15% more shares than originally planned. So, if demand is huge and the price is soaring, they can release more shares to meet that demand. If the price starts to fall, they can buy shares back to support it. It's basically a price stabilization safety net. Another key mechanism is the lockup period. This is a pact where company insiders and early investors agree not to sell any of their shares for a set period, usually up to 180 days. This is super important because it prevents a massive sell-off right after the IPO, which could crash the price and scare away new investors.
So, after all that complexity, the underwriters, the roadshows, the lockup periods, why does this intricate dance matter so much?
Because a successful IPO is so much more than just a payday for the founders. The capital they raise can fuel game-changing innovation and create thousands of jobs. It's the mechanism that allows a promising private idea to scale up and become a major public company that really does impact all of our lives. But it's crucial to remember this: the IPO isn't the finish line. In a lot of ways, it's the starting line of a brand new race, one that's run every single day under the intense scrutiny of the public market. So the real question is always, after all this preparation, is the company truly ready for that?